In this video, we're going to continue the education by using volume analysis and the T3 market flow indicator. A word of warning, make sure that you have successfully learned trading from the edges, the tops and bottom reading, along with our trend trade videos. Knowing both of these is going to be essential for using our volume analysis correctly. Again, I want to give a warning. This is a continuation of exceeding and really exceeding minimum expectations to make $400 per contract per day. Again, keep in mind, we want you to make a minimum of $400 a day, but we want you to have the opportunity to get way above that. So we're going to talk about the market flow. The first thing I want to do is I want to break down the bar structure. What we're going to see is two black lines on every single bar. And just to kind of circle those for you so you can see them. These two little black lines represent the highest volume inside of that bar itself. You're going to also see green dots and magenta dots inside the bar. And all those dots are is a one price comparison between a disproportionate number of buyers versus sellers. So in any one bar, you could have green dots and or magenta dots. It's really the pattern of those dots that are going to color the bars and give us our signals. So let's take a look at the first pattern. And again, you're going to see white paint bars and yellow paint bars and all these things all over the chart. You have to understand what they are, and you have to understand how to use them. So during this lesson, we're going to go through both of those. First, let's talk about what they are. A white volume paint bar down is a multiple magenta dot breakout of the prior bar's low. The white paint bar up with green dots is a volume breakout to the upside. And essentially it just shows you that there's high volume either going up or down, and all of the white paint bars alternate. So there's always one down, then one up, and then one down, and then one up, and then one down, and vice versa. What you're going to see is there's two different uses of these white paint bars. So the very first one down here at the bottom where there's an arrow, if there's a white paint bar down followed by the next bar reversing up, we're going to get an arrow, and that's what we're going to call a reversal signal. Now, the same, and we're going to see reversal signals all over the place, and whether you take them or not is going to be a function of where you are on the chart and the rest of your indicators, not solely based on a market flow chart. The next thing with the white paint bars, essentially a breakout. And what we're going to do is we're in the indicator defining a breakout is having a white paint bar up and then a subsequent close above the top of the white paint bar. And what that's going to do is it's going to create this green line that is an extension of the high volume line from the white paint bar. So again, you're going to see a lot of different things on the chart, but as the market goes up and we have a white paint bar down, we get a reversal. So there's an arrow. And then the market goes up and makes a bar up and a reversal bar down. We get an arrow. And then we get a bar down and a subsequent close below that bar down. And that's really a breakout to the downside. And then this high volume line, the magenta line, becomes resistance, which we'll be able to use later when we talk about trade setups. Now, when we look at fibs, just in general, when we get a breakout of fib support, a lot of times the high volume line will be in line with that breakout of support. And really what we're going to use is the fibs and this high volume line as an entry area, entering on the way up into that area, anticipating the market to go down. If the market's in an established trend already, then when both triggers are crossed down and we get a white paint bar up, we'll anticipate the reversal before it happens. So what that will do is it'll give us the ability to sell on the way up after a white paint bar up by reading the triggers, knowing that we're going to get a reversal to the downside. Again, going to be very helpful when we put it in the context of all of our other indicators. The next indicator or pattern, if you will, that we're going to look at is what we call an antenna bar. I'd put antenna over here just for fun. And you can see it semi-resembles an antenna bar, and all it means is that the two lines that represent the high volume area are above the reversal bar down. So some people call it a doji bar. There's reversal bars. There's a lot of names for it, but we call it an antenna bar. And by itself, it doesn't mean anything, but when we put it at the right spot, it really means a lot for us. So you'll see antenna bars that are also bullish that go up. And again, the characteristic usually is it looks like an antenna bar with, you know, the high volume below the bar and then a reversal to the upside. Again, you'll see these all over the chart. I mean, they happen all over the place. And again, word of warning, we're not trading every pattern. We're only focusing in on the correct spots. The next thing that you're going to see is a yellow reversal bar. And it's really a volume reversal. And what we're using, I just pulled up the indicators here so you could see. It's a 2-bar pattern. And on the previous bar, the current bar, what we need is a 2-to-1 ratio. So if we have 2 magenta dots down, followed by at least 1 green dot up, it'll make a yellow bar. Volume was down, now it's up, it's a volume reversal. Same thing at the top. Green dots going up with an up bar, followed by a down bar with at least 1 magenta dot, and we get a yellow bar. Again, I just want to go over the mechanics of what causes these things to happen. The next pattern that we're going to look at with the market flow is stranded buyers or sellers. And a stranded buyer is essentially an antenna bar. It doesn't have to quite be a full antenna bar. Usually the body of the bar is below the high volume line. But it represents a lot of buyers that got left out in the cold when the market reversed to go the other way. And again, a stranded buyer or seller from a particular spot generally means that the market is going to reverse. And you'll see the same thing down here at the bottom. There's actually 2, there's actually 3, but right, down bars with reversals with stranded sellers on the bottom twice, and then the market goes up. I did put this one in here because a lot of people, the minute they start looking for stranded buyers and sellers, they see them on every bar. So again, at the right spot, and has to be a bar up and then a bar down, or a bar down and then a bar up for it to be stranded buyers or sellers. Has to kind of have that reversal pattern. So if you just see a dot out by itself, it doesn't really mean anything. So just, I know a lot of people ask that. So now, one other pattern that we look at, and we'll show you how we put all this together once we kind of get through the monotony of going through the basics. Consecutive signals, and usually it's a yellow bar, white paint bar. Sometimes it could be an antenna bar and a white paint bar, or a stranded sellers and a white paint bar. Usually the white paint bar is second. And what this means is, especially if it's from the right spot, it shows a lot of strength in the top or bottom that you're looking at. So in this case, we have a bottom Fibonacci support followed by 2 signals up and then a third signal up, which, remember, our white paint bars creates this high volume line. And whenever we have a good bottom from fibs, as denoted by yellow and white paint bars, generally you can buy the high volume line as a buy signal. Notice the white paint bar reversal here too. And then ultimately, as it breaks out, we have another yellow-white paint bar, which represents a lot of strength in the trend. So it just kind of gives us a visual clue as to the strength of the buyers or sellers coming off any particular area. Now, to go through just the basics. Number 1, do not watch the market flow continuously. If you stare at that chart all day long, you're going to lose your place in the rest of your indicators, and you're going to have a really hard time. Just don't do it. Only use the market flow chart and indicators when there's a high probability pattern based on good tops or bottoms or trend trades. T3 market flow signals are going to be used to trade from the edges, which you've already been through the tops and bottoms video, following a weak high or weak low. And you're also going to really need to be confident in your Fibonacci and trigger line readings to use the market flow appropriately. Dual signals like a yellow-white paint bar combination are a good confirmation of the top or bottom. The current strong trend is also going to be confirmed by market flow high volume areas and signals along the way. The market flow will also give you additional confidence entering those trades at the areas by using the high volume lines, the white paint bars, or signals from a key area. And if a trigger line pattern dictates, like the market triggers are a little too strong, you may actually wait for a market flow signal, confirmation signal, before entering a trade at an edge. Finally, the T3 market flow will assist you in your management of trades as well, especially at double divergence or pivot stop outs or divergence potentials. It'll give you a clue as to what's going to happen in the very near future. I want to refocus you back up on one of our very first pictures, right? In the trend trade video, every video, keep in line with trigger lines crossed up or crossed down. When you're starting with the market flow, it's going to make your life easier. Again, trading with the triggers, not into the wrong spot, is a very important concept still. And as we look through these pictures, notice, you're going to start noticing these things, and you're going to say, ooh, a stranded buyers with an antenna bar at a fib. And you're going to get really excited, but it's not really a sell signal because the triggers are too strong. It's an early warning maybe that the area might be good, but it's not a signal because the triggers are wrong. After the high gets stopped out and after the triggers roll over, this is the point in which we want to use the market flow, high volume areas, triggers, and fibs together to give us a really good high probability trade to the short side. So again, don't lose sight of this look when you're looking at your market flow, either to the long side or the short side. Same thing even with a market flow chart. As we step back a little bit, and I also want you to keep in mind, if you have a great bottom in place, which is not defined really by a market flow chart, it's defined by a 14-2 chart, then the subsequent high volume lines with triggers and fibs become a very powerful launch pad for you to take long trades. The same is true if you have a great top in place as dictated by the 14-2 fibs and triggers. Then when the triggers roll and you have a white paint bar down that gets taken out and it creates a high volume line, it's going to give you a little visual clue on where to get in going the opposite direction. And you're going to see this, over and over and over. Once you get the concept, we don't have to spend a lot of time with it. Fibs, which are great, but after the triggers roll, this look right here will help you with your 5-1 trend trades. You'll have a lot more confidence taking a 5-1 trend trade at the mid bands and fibs with this look on your market flow chart. Now, just to kind of work our way into a few more charts. So again, this is a very typical scenario where you get a strong top with divergence and fibs and weak triggers, and the market starts to trade to the downside. And, we're not trying to sell the top. What we're trying to sell is the first pullback. And what happens traditionally is you have a 5-1 trend trade, which would be about right here at 33, 34. And when you look at your market flow, you see that the market flow high volume line is at 33, 35, 50. So the only thing, not that you won't take your trade here, but you don't want to put your stop so tight that you get stopped out before the market goes down. And I put in the next slide to that. And you can see the market did, in fact, come all the way back up to 33, 35, 50, and then stranded buyers, and then reversed to the downside. So you still may get in on the way up. You just have to be aware that your stop is going to have to be out of the way in case we do run up to a high volume area. Then, again, same thing. This is the same setup. So we had a strong top and we had our first short, right, from 33, 35, 50. And as the market's trading down, generally this is the point where most traders are going to stop. And again, it's one of those things that the experienced traders will take one more short, but they need something else to help. They might have one-to-ones on the 5-1 chart, but adding in a new high volume line with the trigger still going down allows their traders to sell at 33.32 on the way into that line, and then a very tight stop, and then they can manage that position as they get down here. Without that market flow high volume line, you're not going to have enough confidence to just sell a one-to-one after the fibs hold with a little bit of divergence. Keep in mind, the reason you can do that with the strong triggers is because you came off of a very strong top. So there's a lot of needing to know where you came from and how you got there if you're going to be able to take that last trade. But the market flow will make that last trade possible. Another example is when the market is trending very heavily and we've got very strong triggers, and believe it or not, this is the next trade in almost that same scenario. I mean, this happens, same look almost every day. The market will go down strong and then we'll get a market flow signal. And even though we're at support, we don't really anticipate it to hold because of the strength of the triggers, the fact that the smaller chart is changing, and you're probably going short anyway on the way back up. So when you have a white paint bar up, we're usually selling when both triggers are down, anticipating this reversal to the downside. And again, you see short, and as the market trends down, you know, there's basically two shorts, one up here in the magenta area that had two market flow sell signals. And then the second short in the yellow areas is a pretty easy look. I think everybody would be getting short on the way up, and then after you see an antenna bar down, it just confirms what you're already doing. Another use of the market flow high volume area after the triggers roll is going to happen when you get to an edge of fibs. And, you know, look, we love one-to-ones with a red fib. That's a great termination condition, but the triggers are a little strong and we have to kind of watch out for that. So if you were waiting for the fibs to get hit, you would never take a trade. So the fact that we had a market flow high volume line with our small triggers crossed over right here would give you the ability to sell that area, maybe make 4 points plus, and then obviously manage your position. Without the market flow high volume area, there's no way, based on the rules, that you would have gotten a trade. Now you'll see this happen really time and time again. Eventually we have divergence from fibs and it makes a good bottom. And most traders are buying 33.42.50 at the mid bands and one-to-ones, which is not wrong. But when you look at your market flow high volume area and some of the spread on these triggers, you can have to anticipate that it may come back a little bit lower. So if you do get in at 42.25, you're going to have a big enough stop to encompass all of your fibs and high volume area to keep your stop out of the way. So you might have to risk 4 points on this position, or you can attempt to get in a little bit lower, closer to the high volume area to mitigate some of that risk. Another use of our market flow, which is very, very consistent, you know, you're going to be watching for obviously a trend trade in this area. Strong move, big breakout, tons of fibs, everything is perfect. You're going to already be into your position before it gets there. You don't even get a market flow signal, but market flow is not always needed when you have perfectly easy trades. It's, you know, and this is where some of our traders, they'll say, oh, I'm waiting for a market flow signal, and they'll miss their perfect trade. So you can't do that when you have the perfect look and the perfect strength on all charts. You have to get in and not really worry about using the market flow in this situation. So I did want to add that in there as well. You're going to see this look a lot. Obviously that last one from the bottom went up quite a bit, and then this is technically the next look, right? We broke fibs, it's strong. You're going to get a white paint bar into a trend trade spot. And we love this look, especially when all of the triggers are going up. The idea is that after the white paint bar down, we're going long, anticipating a reversal. And it's a little bit scary at first because you're going to say, John, what about the yellow white paint bar combination? It scares me. You said it's a good top. You have to also keep in mind, what areas did that happen from? No areas, no top. Strong triggers, no areas, really no top. And when you buy after the white paint bar down, the hope is, and this one did, that the market is going to indeed make that long signal arrow for us where we can reduce our risk, and obviously the market runs away in our favor. Now, same situation here, right? We have strong triggers after a good bottom. I think that's easy to see. And you're probably buying into the mid-band anyway. If you had any hesitation after the white paint bar down, you would be buying the market anticipating a signal to the upside. And again, it took a minute, but they finally did go to the upside. So we didn't put in any divergence or change anything. So again, just a nice heads up that it's okay to buy the market. You don't have to wait for a signal when all the triggers are strong. We love to see white paint bars into our areas. Now, one more for you. This is another trend trade long, and this happens a lot. And this was, white paint bar into our area. And a lot of times this happens, and, again, depending on your large chart, most traders will leave their stop down here so they won't get stopped out, and they'll at least force the market to make down bars on the large chart. If for some reason you got in and you got stopped out because of divergence, you don't really want to miss the rest of this move. So if needed, you can use a market flow signal to re-enter a position if you got out or got tricked or didn't have a big enough stop, recognizing that, hey, there's a nice reversal signal from the area. Let me jump back in so I can take advantage of knowing where the market's going to go. And exiting, remember, we always exit into the fibs, especially when the triggers are weak. But if you did not, for some reason, notice the configuration of the market flow at this area. Stranded buyers at a fib with a reversal bar. So if for some reason you were hanging on for dear life, this is a clear signal that we're not going to go up anymore at this moment in time. Stranded buyers from fibs is great. Stranded sellers from fibs is really great. Another way you're going to use the market flow, again, I have to say, you're already going to be in a short trade, right? Market's going down, you're selling a pullback, everything's going down, happy times, right? Well, if you get in and you get a second signal, so especially when it has triggers down and a market flow high volume line, a lot of our clients will add on to an existing position when the market flow helps in order to double up and make more money on their position. Another thing that they'll do is they'll also trail their stops behind a couple of down bars on the market flow as they start to get closer to target areas. Again, this was a really easy one, but you're going to get this first one anyway if you're watching your charts. The real benefit is the confidence to add on more at 33.1475, anticipating this area to give you even more profit. One more with the trend, and then we'll do some tops and bottom work, okay? So big breakouts, strong triggers on your smaller charts. I think this is really easy to see, right, on your 14-2 chart. And a little divergence that takes you back up to the higher resistance area. You're going short anyway. You have to. I mean, without market flow, period, that look, you have to sell with both hands and hope for the best. Now, once you enter your position on the way up, the next market flow bar down doesn't really get you in or help you, but it sure does make you feel good. Because when you see that stranded buyers from Fibonacci resistance, you're really happy you're into your position. And then as the market's going down and you get a retracement back up, if you were to get a subsequent sell signal with all the triggers down, you may even add on to your position, since you're adding on in a position of a profitable trade. I don't like adding on when you're not positive on the trade personally, but if you're already positive, adding on is a good idea. Now let's talk about tops and bottoms. Again, very important, read your 14-2 charts first. All of your fibs and triggers at the fibs are going to determine whether you're even looking at your market flow or not. If a strong bottom or top is true, you can use the market flow for entry, but again, we talked about this in the tops and bottoms video. You have to anticipate that minor areas in the way are going to break and train yourself to ignore those. It also includes ignoring market flow signals that aren't with the expectation of the Nexgen dynamic Renko bars and triggers. If you have a weak top or bottom, again, not that you can't take a trade, but you might manage those a little quicker. And if you're trading from the edges on a larger edge, right, not a 5-1 trend trade, but after the 5-1 gives out and you're trading from the bigger areas with the bigger charts, then you can use the market flow to help you with your entry. And again, sometimes waiting for the edge and waiting for a reversal bar or signal is not a bad idea, because you're anticipating a lot more profit on those trades, so you don't have to be in on the way up or on the way down. You can actually wait for a reversal to get into your position. If it never happens, you don't get one, and if it does happen, usually they give you an entry. Also, again, I say this in every video, never ever ever counter trend trade against very strong 14-2 triggers. It's also true with the market flow, just don't do it. So let's take a look at an edge, okay? If the market's going down, we're going to do a trend trade short. It's a given, okay, on the 5-1 chart. And you've seen this pattern more than once. The divergence with the green background and the pivot stop out makes it go back up to the edge. Noticing where your prior high volume was helps you define that edge. Maybe makes you more comfortable enough to get in right away, or maybe after a reversal bar, either or. I got in early on the way up. And then once you get a pivot, you control your stop. So, you end up making 10 or 15 points sometimes on some of these bigger moves, and you're really using high volume areas and market flow signals to fine tune that. You're going to notice down here where your 5-1 trade gave out, we're going to talk about this more, but this pattern happens almost every time, where you'll get the yellow-white paint bar, a white paint bar, and a green high volume line, and then it stops the downtrend cold and it'll go back the other way. We'll talk about that more in the next section. Remember what we said, if you make a bad top and you're anticipating a good bottom, right, and you're getting in at the edge, or you're waiting for stranded sellers at the edge or a reversal bar, you have to ignore small things on small charts. You also have to ignore the market flow signals that do not jive with the larger chart expectations. I know this is difficult for new traders, but new traders will be like, well, I got out, there was a market flow signal. But same thing we told you with just the dynamic Renko bar charts, you can't get out if it's not supposed to be a short trade. Now, another important concept that we talk about a lot is Fibonacci areas, and then ultimately Fibonacci edges. Edges are a very powerful thing where it's either going to break or it's going to reverse. So we do a lot of business at the edges, and depending on the triggers, this is the point where you can really watch your market flow. Remember what we said confirms a really great edge at the market flow? If we get a yellow-white paint bar combination from an edge, it's a very powerful volume reversal that if we get a quick pullback, usually we can go long. This one didn't, but usually They give us an opportunity to go long. And what we're doing is we're basically immediately classifying a top or bottom as good once we have a yellow-white paint bar from that top or bottom, assuming the triggers didn't get past it. And we'll see this in a situation where, we use one of our termination conditions. Weak triggers just past a fib, along with double divergence, pivot stop out on the 5-1 chart. So we all know to stop taking long trades. This gets more powerful and more clear to the new user when they see their market flow generate divergence and a yellow-white paint bar followed by more down bars. Now you know the top is good because all three charts agree that the top is good. And what it does is it makes you more assertive, selling the mid-band and fibs at the first trigger, knowing that the high volume line is a couple ticks away, helping control your position to the downside. And again, when we get down to targets like mid-bands and fibs, you can also use the prior high volume area as a target. So not only are you recognizing the top after a double termination condition and a market flow yellow-white paint bar, but you're confident to do the short, and you're also visually targeting 41.79 as your profit target, which puts you down here and down here, maximizing the short position, using the high volume area also as a target. Now, again, this is a little bit squished up because I had 4 charts on here, but again, when we get to fibs with a weak trigger, sometimes you get a trade before the triggers ever even roll. So let's take a look at our, we'll go from left to right. Weak triggers at a fib, and you can't really see the top on your 5-1 chart. But we also had a pivot stop out at a prior divergence on the 21.3 chart. And we also, on the market flow chart, this is the sealing the deal for us, divergence and a yellow-white paint bar. So we know it's probably going to be a good top before these charts ever even roll, giving us the ability when the triggers roll on our market flow chart to sell the high volume line, especially with a white paint bar up, and we get that first short trade, and you can see something at a prior low for a target, and then that's also very close to support. And then finally the 14.2 chart rolls, and during this pullback to 35.73, we're also recognizing fibs, and we're also recognizing high volume line with a white paint bar into the fibs for one more attempt at the short, which it did go down. So this gets you extra confidence at the top, number one. It gets you a quicker trade, because if you waited for everything to roll, you were taking the first trade here, when in actuality that was your second trade. So it adds this much profit. I mean, that's what, 6 or 7 points profit extra into your bottom line. Now, if you make 1-to-1s and weak triggers and a fib top, again, this is the same look almost, but a slightly different configuration. Large triggers roll on your 5-1. Also, you have a high volume area at your fibs, giving you extra confidence to pull the trigger on that short trade after you've already made a good top at 1-to-1s with weak triggers and fibs. So it's this high volume line, and your small triggers are down, gives you the confidence to go immediately inside of that little window, and then obviously take advantage of that move. Now, again, going back to the tops and bottoms video, right? Weak bottom and recognizing you have a weak bottom is a very important concept when you're trying to sell up here. And again, a lot of people don't know how to time the entry up here, and this is what the market flow is going to do for you. When you make a weak bottom, or not a great bottom, and the market goes back up to that top, instead of wondering how to get in, we're going to rely on our market flow to give us some type of a signal. If we had a prior high volume line there that was great, that was pink, or a white paint bar and a reversal into it, and it's okay to get in after the reversal. So that way you have a signal for sure, and even if you pay a few extra ticks, you've got visual confirmation that it's the right thing to do. So you may get, if you get in on the way up, obviously you're going to make a little more. Confirmation costs money, but how much more confident would you be when you put all three pieces together? Starting at a good top with fibs and divergence, strong push down with very strong triggers down, and the 21-3 chart was down good too. Reaching fibs with very bearish triggers and then getting a signal. It's a really good recipe for trading the edges. Now, as you're learning, this is kind of the thought processes that are going through your head. You're looking at your fibs and your triggers, and you're like, oh man, I have to figure all this out. So watch. I'll read it out to you, and again, this is what we teach, but I'm doing it in three phases. First, the small triggers get above the large triggers. So it's a little warning. We're kind of weakening the strength. And then we reach the edge of fibs, which is our magic spot, right? The last fib with the prior divergence and a little pivot stop out, and the triggers aren't going to break through. So it's at this very moment, at the very low, that we can either start watching our market flow, or if the market responds to this, we can use the market flow high volume areas or white paint bars into a trend trade and try to take advantage of the move up. I denoted this one or annotated it a little less, but it's the same pattern. Triggers weaken below the large triggers, and then we come back up and to make a really good top right from the edge. It's at this very edge that if we get a market flow signal, we're trying to go short to jump the edge. If we get it, great. If we don't, we don't. We'll have to wait for a roll. And you'll start to really focus in on some of these very edge with weak triggers with divergence potential as very, very good market flow spots. If you get a signal going the other way, you're really able to take advantage of knowing where that top or bottom ought to be. We did one the other day in crude oil. This is the 18th of November, so a few days ago. And recognizing that we didn't make a real good top, and then we were making a very weak trigger line top into the edge of fibs. So right at that edge of fibs, we start watching our market flow, and lo and behold, one of our favorite bars, right? Stranded buyers, antenna bar for a short trade. Now, it was the first short, and these triggers didn't quite get weak yet. So again, the high volume area was 42.41. Original target was down at 42.05, which I think started out a little bit greedy. Until, here's the follow-up on that, just to show you what it did. You can see took profit here at the first trouble spot. And then, unfortunately, I was looking for another sell signal right here. As you can see, obviously, after the good top, we want to continue selling and not one pullback, which is a little unfortunate, but still it's the same pattern whether you get a fill or not. Weak top or a strong top, right? Weak triggers at a good top with divergence, with stranded buyers with an antenna bar, go short, take some money, sell a pullback, or stay in for the whole thing, either way. Again, you don't always have to make all of it to make a bunch of money, but you get the pattern and kind of the idea. It's this recognizing the patterns at the edges that will allow you to really take advantage of the market flow from those edges. Now, if that was the top up here, and then it went all the way to the bottom, and just so happened, same day, same market, the market made a bounce from fibs, but the triggers were strong. And then the triggers got weak, and we were right at the edge of fibs, which is like our best spot ever for either do or die. Unfortunately, there wasn't a great market flow signal from the low. So we were kind of forced to wait until the triggers rolled over, right, on the 5-1 chart and the market flow chart. And you'll see what happened. The market came off the bottom and we had multiple bars above the white paint bar, which draws in this green line going sideways. And when we get the green line and triggers and fibs to line up with the trend trade that we want to do, fibs and trigger trade at least, after the edge is good, we end up with a really great trade. And it's the triggers over here and the high volume line over here that give you a lot of confidence to be able to buy this Fibonacci support, because you recognize that it's going to be a good low. So before you ever got to the market flow portion of what we're doing, you had to recognize the low, you had to recognize the potential buy spot, and then finally the market flow confirmed what you were already thinking of doing. See how that goes? Now, you're going to see this again, a bad low on the large chart, followed by divergence, followed by a green background, followed by market flow long signals. So we have a lot of warning that we're going to go back up to the top. And we're going to try to sell the edge again. And I just wanted to put this one in here because it's a mistake a lot of new users make. They're like, oh, I thought I was selling the edge with this signal. They say it all the time. I hear it like twice a week at least. You're not at the edge. Price did not reach the edge. So if price doesn't reach the edge, that's not a signal. That's just a random signal in the middle of nowhere against the triggers going the wrong way, not at an area. So again, very important. You're only focusing on signals that are at the right spot. Now, once you get to the right spot, then, look, you can see we had an antenna bar and a down, and we pulled back up to it. So as we retested the high and made this pivot stop out, that's a much more appropriate place to attempt a short trade, which it did go down. And again, when you're reading through your charts, you're going to get to fibs, and with the trigger strong, you're going to wait. And you're still going to do 5-1 trend trades and arrows to the downside, white paint bars, and high volume lines. And then it's going to give out, and then you're going to try an edge trade, and then you're going to get to the next edge with strong triggers, and you're going to be waiting, maybe selling one more time at the top. And then when you reach the edge the second time and you recognize the trigger line configuration right over here where this -99 is, this is the only place to look for a market flow long signal, if you get it. Right at the edge when it's supposed to hold. Knowing that is key in what we do. Same thing at the top. This is termination picture from the first video and second video. Weak triggers at a fib, 3 divergences. When these triggers cross, this is the moment in time to find that high volume line. To find a reason on the market flow to help you out so you can take that short trade. Now, market flow, as you have well imagined, you've already seen, it's going to help you with the management of your trades as well. So this picture gets used over and over and over, and I use it 10 times a day in the class, and we use it in all the videos. And the idea here is that you can't see change happening on a 14-2 chart. Triggers are strong, and you're going long, and you're holding on for dear life, and at some point the market puts in too many divergences or wrong colors or pivot stop outs and triggers rolling, and you have to know when to quit, right? And you're going to see this a lot. It's in, there's another one from our other trend trade edge trade video. Eventually, this smaller chart's going to kind of give out on you, and it's going to go back up for a higher area. So when you're watching your charts, and again, there's 2 pieces to this puzzle, right? Strong down, and you're going to sell a white paint bar up, anticipating a down bar. So you got your short. And then, maybe you went short again, or you're hanging on for the rest of it, or whatever. Notice when the background color turns green here and you have divergence potential. When you get the high volume line and the triggers rolling over here, you have to really start to anticipate that this divergence is going to maybe hold. You don't have to get out right away if you're short, but you have to really start thinking about, why do I want to stay in a position? And the market flow will generally start barking out long signals when it's time to get out at a potential management spot. Look, we'll go forward, and this was another one from Friday even. That was from the 20th. So the market's screaming down, and we sold 61.50 as a last trade short. And this is what happened. Look at it. It's the same thing, yellow-white paint bar with a green high volume line and the small triggers rolling up. And this area eventually took the market all the way back up to like 35.70. So again, this is an early warning system for you when you're, this is, again, you can see it a million times, but when you get short the last time and the background turns green and the high volume areas barking at you with the triggers, start paying attention to it. Again, this is another trade that you've seen already, and you've seen it in the other videos, but now hopefully this makes more sense. Look at the market going down, and you're going to take a short, right? Short from about here, and then divergence with a green background with a pivot stop out. And then you notice your market flow has a yellow-white paint bar and also has high volume lines and long signals barking at you at that spot. Which doesn't mean the market's going to go down forever, but that's the usual look to take you back up to your higher area so you can go short from a higher area. And again, keeping in mind, it's important to ignore those when it's like this at first. And then when our triggers are inside of each other, you can really pay attention to what's happening at the market flow when you're stopping your trend trades. Another example, let's assume that it's been a strong trend up and you bought the mid band for one more time up. And you'll start to see running into high volume lines with down signals usually will make the market go back down again. Really easy concept, but once you see it and somebody points it out to you, it's like, wow, it's really obvious. Now, on our other video for tops, bottoms, and even when to stop trend trades, remember this look? Divergence from a fib without the triggers breaking through. Well, same thing at the bottom. Pivot stop out with divergence at fibs and nothing breaking through. These are the two moments in time when there's divergence potential to watch your market flow. You may get bonus trades. Also, as you already saw, this is another termination condition. Weak triggers at fibs with a couple of divergences. Well, over here, it's time to start watching your market flow, especially over here after the triggers weaken. You start watching your market flow over here and you get the first short, and then after the triggers roll, you get the second and third shorts after it. So it's really able to give you an extra trade from a lot of the tops and bottoms, which is really going to add to your bottom line. One more time to say it because I have to say it 150 times. Not a great top makes a great bottom. If you get a great bottom, ignoring the small stuff, even the market flow becomes very important. White paint bars into trend trade spots become very helpful. Here's the double version of that, right? Same picture. But again, the reason we ignore this is because of the 14-2 chart. And again, ignoring these market flow signals that have nothing to do with the potential outcome, it's hard to do, but you have to start doing it. You'll be a lot better for it. Again, remember this termination condition where we have multiple fibs in a yellow 1-to-1? Watch your market flow. Remember this termination condition where we have a pivot stop out at the edge of the fibs? Watch your market flow. When we have a not great bottom, watch your market flow for one more short. After we make a great bottom, especially if the market flow confirms it, trade until we get to a great top. Watch your market flow. Trades to the short side, high volume areas and edges to the short side all the way back down. Finally, context of your fibs and triggers is ultra important with the market flow. Market flow is a very powerful addition, a synergistic type indicator to use with your fibs and trigger line reading when you're doing it properly. It'll help you fine tune your entries and exits, help with your management, give you a couple extra trades a day. And just like always, start your analysis on the large charts from the big swings so you know where you're at inside of the context of the market. Don't take trades against strong triggers, even with the market flow. And I say this all the time, post pictures of your charts, annotating why you did something on your chart so we can make sure you're getting the right read and the most out of your software. Thank you for your time, and I'll see everybody in the room.